We talk obsessively about the art of getting rich, the aggressive accumulation strategies, the high-risk, high-reward ventures, the hustle culture. Yet, almost nobody in the mainstream media talks about the far more critical science of staying rich. The brutal, often ignored truth is that 90% of individuals who experience a sudden massive wealth infusion, a lottery win, an inheritance, a successful business exit, go broke within a few short years. Why? Because the skills required to acquire a fortune are fundamentally different from the ruthless discipline required to preserve it. My name is Corbin, and this is Corbin Wealth. Today, we shift our focus entirely from the growth phase to the defensive architecture. The truly wealthy, the families, institutions, and individuals who sustain generational stability across market cycles, operate by three ancient unbreakable rules of capital preservation. These rules are not about predicting the next boom. They are about eliminating the psychological and structural vulnerabilities that guarantee ambitious people crash straight back to the financial Stone Age. Rule 1, the principle of non-zero-sum risk. The first and arguably the most vital rule of capital preservation is deceptively simple. Never put money in a situation where the probability of going to zero is remotely possible, regardless of how intoxicating the potential upside may be. This fundamental principle is violated every single day by smart people who chase the latest, highest risk schemes, be it highly leveraged options trading, speculative penny stocks, or putting their entire life savings into a single, unproven startup. The reason this rule is unbreakable lies in the brutal asymmetrical math of recovery. If you have $100,000 and you manage to lose 50%, you are left with $50,000. To simply get back to even, to the starting line, you now need to earn an astonishing 100% return on your remaining capital. A 50% loss requires a 100% gain to recover. Now imagine a 75% loss. You need a 300% gain. The math of recovery is so punishing that the truly wealthy understand eliminating the possibility of a catastrophic loss is mathematically superior and infinitely less stressful than chasing a massive speculative gain. This rule translates directly into creating a deep, unbreachable moat around your core capital. Your most critical money, your emergency reserves, your liquidity for life's unexpected tragedies, must be placed in ultra-low volatility, safe harbor investments. Your goal for this capital is not to generate aggressive growth. It is the absolute, non-negotiable preservation of purchasing power and psychological stability. Rule 2, the principle of permanent asset diversification. The second rule acknowledges a fundamental historical truth. No single asset class is safe forever, and the illusion of safety in one area, be it 17th century Dutch tulips, 19th century railroad bonds, or 21st century tech stocks, is always shattered by systemic shocks. The wealthy never hold all their capital in one basket, not in a single country's bonds, not in a single city's real estate market, and certainly not in any speculative single-point asset. The goal is not to predict which asset will perform best next year. That is an ego-driven fool's game based on guessing. The goal is the elegant, protective construction of an ark of assets that are structured specifically to perform differently in different, often opposing economic climates. When global stocks crash due to deflationary pressures, defensive allocations like precious metals or long-duration bonds may stabilize. When inflation spikes due to central bank overreach, commodities and strategic real estate purchases preserve value. This means maintaining strategic, often non-correlated allocations across different geographies, different economic sectors, and different types of assets, e.g., productive capital, like established businesses, versus defensive, non-productive capital, like physical precious metals. True diversification is a complex, constantly monitored matrix, ensuring that when the major growth pillar falls, the defense and preservation structures remain intact, minimizing the capital drawdown to manageable levels. Rule 3, the principle of debt zero for preservation. This rule represents the most critical shift in the transition from acquisition to preservation. In the aggressive growth phase, intelligent debt, leverage used to buy income-producing assets, can be a powerful accelerator. But in the preservation phase, debt is not a tool. It is a structural weakness, a potential systemic liability that cannot be diversified away. The shift is critical. When your objective moves from building wealth to preserving it, Your mortgage on your personal residence is no longer viewed as a good debt or a tax deduction. It becomes a major liability because it represents a mandatory outflow that must be serviced regardless of market conditions. The goal of the wealthy in this phase is the complete elimination of all non-strategic, non-collateralized debt once core capital targets are met. By zeroing all mandatory outflows, mortgages, car payments, personal loans, you are constructing a fortress of financial stability that is immune to recessions. This final, comprehensive shift in mindset maximizes your resilience during the inevitable economic crashes and minimizes your reliance on continuous, high-pressure, high-income labor. The fundamental, non-negotiable goal of the preservation phase is to permanently decouple your necessary lifestyle expenses from your immediate paycheck and the market's whims, thereby effectively neutralizing the market's coercive power over your day-to-day existence and your career decisions. Consider the vast chasm between the two contrasting financial scenarios. The individual with $5 million in diverse, unencumbered assets and zero debt is not merely better off. They are infinitely more secure and possess vastly greater freedom of action, psychological bandwidth, and strategic agility than the individual with $10 million in highly leveraged, debt-ridden assets. The person holding $10 million may post a higher net worth on paper, but their reality is one of precarious structural fragility. Their $6 million in highly leveraged debt acts as an existential structural chokehold, requiring mandatory, rigid, non-negotiable debt service payments regardless of whether the market provides adequate returns or whether they can maintain their high-pressure, high-income employment. Should a severe market dislocation, a black swan event, or even a localized recession occur, the highly leveraged individual faces margin calls, the forced, demoralizing sale of assets at depressed, panic-driven prices, and the very real possibility of bankruptcy, as their liabilities remain fixed and immutable while their asset value evaporates. Conversely, the individual with $5 million in zero debt is not only completely insulated from this systemic risk, but they also possess an asymmetric advantage. They have zero mandatory outflows, allowing them to watch the market volatility with serene calm, knowing their core capital is preserved, their time is their own, and they are strategically positioned and financially liquid enough to acquire valuable distressed assets from the very individuals who were forced to sell. True wealth is not measured by the peak, paper-thin value of your assets. It is definitively measured by the stability of your unencumbered capital during a crisis and the number of consecutive years you can survive and thrive without exchanging your time for money. By adhering to this preservation rule, the wealthy ensure they never lose the game, guaranteeing their position and expanding their influence through market cycles, while the highly leveraged speculator, driven by the illusion of maximum growth, frequently sees their empire crash back to zero.